Okay. Now I want to talk about the companies with dubious earnings a bit. But before we talk about companies with dubious earnings, we'll learn some fundamentals first. Now, the most common fundamental analysis ratio, I believe, it's a PE ratio. Most people all talk about, not all, but most people when they talk about fundamental or they buy companies that are cheap, normally they define it as PE ratio. ROE is ROE is used to find good companies, because if company that earn high ROE means basically it's company that earns high profit in relation to the company's equity, which means basically you're buying good companies. So PE ratio is used to find cheap companies. All right. So PE ratio is calculated by the price divided by earnings, which stands for PE. Now price, it's universal. It's most people take is the latest stock price or latest market price, or past few days or something like that. So the price have no issue. Now the issue comes in the earnings, because the different reports or different research house or different analysts use different types of earnings. They could use the latest 12 months, or some use the latest audited results. Some use forecasted earnings, and some they use combination. I've seen some like the past 2 quarters. They use the past 2 quarter historical and the future 2 quarter that they project. So all kinds of things. That's why every PE ratio comes different. So the E that you use is extremely important. So the key thing is our advice is to you exclude off a number of things. So what are the things that you exclude off? Okay, so here the first thing I would advise to exclude off is currency translation difference. Why currency translation difference? Currency, because if our ringgit has become weakened compared to say US dollar, it doesn't mean that our ringgit will continue to weaken every year, no. So unless you expect our ringgit to weaken every year at that same percentage, but that's unlikely, you see. If, like example, last year our ringgit has dropped by 20%. This year it's unlikely to drop another 20%. Maybe it might drop another 3%, but we cannot expect our ringgit to drop by 20% every year. I think that's
it might also happen the other way, so you never know.
Yeah, correct. Yeah, correct. So in that sense, this is not your day-to-day bread and butter income, currency translation difference. So no. At the same time, since we are talking about currency translation, if your revenue also exclude revenues that gains from this currency translation. In other words, if you see a company where the revenues, they say example they export something and they export in US dollar. So if they export in US dollar, then last year because our ringgit have dropped, that revenue shoot up a lot, which of course out because it shoot up a lot, then a certain percentage becomes profit. So the profit also goes up a lot. Now, if this kind of profit goes up a lot, you have to understand that this profit is again is because of the currency translation. So in that sense, you want to exclude this kind of earnings gain. So you have to count in such a way that you assume that the ringgit and US dollar remains the same. So in other words, if there's a huge change, then you have to see in years where the changes is not so much, then you should use that kind of earnings. Yeah. Am I making myself clear?
Yeah.
Okay, so in that sense, this example is probably you can, if you find a company that exports a lot, especially to US, and then they will have recorded a huge gain in profit, then the earnings will suddenly shoot up a lot. Then you can see the PE ratio suddenly becomes very cheap in terms of PE ratio. But you have to understand the earnings is one-off earnings, or not normal operating income. Of course, the company will put it as operating income, but you have to understand it comes because of currency gains. So in that sense, you should be minimizing or adjusting the earnings so that it excludes those currency translation. Right. Then another one is sale of assets. Sale of assets or gain, sale or gain from sale of assets. Gain assets or subsidiaries. If there's a public any companies and then they sell off their subsidiaries or they sell a portion of the subsidiaries and then they gain from this kind of assets, these are also one-off earnings. So in that sense, these are not operating income. So basically, in short, you want to exclude all those earnings that are non-repeating. Non-repetitive. So if you find that any earnings that are non-repetitive, then you exclude it off. You should think like a banker. No? You should think like a banker. If let's say that means if you own a bank and then someone want to borrow money for housing loans and then they show you their income. Now, from their income statement or the total income, then you have to see, you only take in the income that is consistent or the repetitive one. Basically, that's why they like salaried workers, salary employees, because they have a consistent income. Whereas if you are commission earner, then suddenly you have a huge bonus or something. Normally they will exclude it off, or they take average of past 2 years or something like that. So likewise, when you're doing your valuation, it's also the same thing. You want to exclude all this kind of non-repeating income. Then only you use the appropriate E. If you are using the latest earnings, or alternatively, you can use the formula. Yeah, the formula is the one that used. The one I use, which the calculator P ratio. Calculator P ratio using the average of ROE, or the back in this, you probably should use quartile 1. Then divide the price. The price to book value divided by here, the average of ROE. So this one is using based on its book value and based on its ROE. So this one is more consistent. You will not have so much ups and downs like if you are using the latest company's earnings. Okay.
Good.
All right. So okay. Now let's take an example so that you can see how you can uncover those kind of one-off earnings.